when there's a topic that is related to FAR or to financial reporting, we are going to first talk about that topic from financial reporting, and then we are going to discuss the GAAS or the audit guidance as far as that is concerned. So yesterday we already spoke about what are subsequent events, specifically what is gap rule regarding subsequent events. And the best way to understand this is via examples. If on 31st of December, there is an event which is already pending in your books. So here, okay, okay, I think they've upgraded something here. Okay. So let's say if on 31st of December, there is already something which is existing on the balance sheet date. Lakshmi, just give me a moment. I will take your question. Okay, it's a good question. Just let me hang on for some time. Okay, so what is a subsequent event? We said that if the event would have occurred as at the balance sheet date, that means 31st December, the event has already occurred, and you get some clarity on that event. So we spoke about three scenarios, right? So let's say we are talking about a situation where this is 31st of December of year one. My accounts are closing on this date, but by the time the audit report is dated, the audit report is typically dated, let's say, is 15th of 15th of February. And let's say the final release that happened of the audit report, let's say that is happening somewhere after 2 days, 17th of February. So the question is, what kind of events are we talking about? And second, what is the auditor's responsibility? So I am going to go to a particular concern to audit, and I need to know what is my job. Am I supposed to stop my, my audit procedures on 31st, on 15th, on 17th? What about anything that is discovered subsequently? So what is my role as an auditor, and when am I actively responsible for looking for subsequent events? Okay, so it might be that COVID has hit. So way back, I think 2020, 21, when COVID was really, sorry, please mute yourself. Please mute yourself. When COVID was actually rampant a lot, at that point of time, what if, as an auditor, I want you to talk about your going concern continuity as far as COVID is concerned? Is there any additional disclosure for COVID? Shall I do it till 15th? Shall I do it till 17th? Till what extent I'm going to do this? Now, see, first thing is, let's go to gap. First of all, we know that as an auditor, I have a very clear cut demarcation given to me, which says that in case if the client is following gap, I'm going to give you an unqualified or an unmodified opinion. In case the client is not following gap, then it is adverse or a qualified event. If I'm not getting evidence, I'll give you a disclaimer of opinion or a qualified opinion. I know this is the hierarchy given to me. So what is the first step? The first step is to understand, is the client following gap? Okay, so if I look at it, my first step is going to be, is the client following gap? So step one is the client following gap? Because if the client is following gap, then I know that it is either an unmodified or an unqualified opinion. And if it is yes, and if it is no, then I know for sure that I will have to give an adverse opinion or a qualified opinion, depending on what kind of a problem is it that exists at the client surface. Now, the moment I know this, now the question is, what is gap saying? So I say, okay, let's go and see what gap says. The gap says, if the event is existing as at the balance sheet date, I am going to give a journal entry for that event. Say, for instance, there was a debtor who was featuring in your books for which you have given your bad debt provisioning. Suddenly, that debtor became bankrupt. So imagine a situation where I'm in a business and I'm providing the goods to hotel business. So let's say I am a fruit seller or I'm a vegetable seller and I have provided a huge amount of goods to a particular hotel and that hotel declared bankruptcy because of COVID. If that happens, I already have a debtor in my book. So my balance sheet did show me debtors as an asset. Now the value of that asset has come down. So we say that please revalue your assets and book the loss in your books. Why? Because there is an event which is already shown in your balance sheet, and now we have a clarity on that event. The same thing goes for any litigation. Some court case was filed against you, and that court case was existing as at 31st December, and now you have a court settlement in against you, and that outflow has been determined. So in either case, we say that please go and make that journal entry in your books. Has the client done that? If no, qualified or adverse. If yes, unmodified or unqualified. Now the question is, what if that event did not exist as at the balance sheet date? Let's say if there is a new thing that has come up. I have made a new, so the best way to remember this is through examples. I have got into a new business combination. I suddenly sold off a major check of my capital stock. There was a debtor who had no problem. He was a fully well performing debtor, but suddenly something happened after the balance sheet date, which made me to know that yes, this debtor will not pay me. Something which did not exist. There was no doubt in my mind as at 31st of December, or some court case that was filed after 31st December. So in all these scenarios, we say that it's a post balance sheet event. We call it technically as non-recognized subsequent event. And for this, all we need to do is disclose. We don't need to we don't need to give a book disclosure. So this here actually you will pass a journal entry where you'll devalue the debtors, or let's say the provision, because typically if you are doing accounting, you don't touch the debtors ultimately unless and until the debtor has actually been written off badly. So you will make that journal entry disclose and you will only disclose. Okay. So the first rule that we say, if it is following GAAP, awesome. We don't do anything about it. If it is not following GAAP, that's the time you give an unmodified or an unqualified opinion. Then what you do, you go to step 2. Step 2 says what? Step 2 says that till the report release date. Okay, now first let's just go through what the text says. I think that will give you an idea. So see, when GAAP is concerned, GAAP, this we've already spoken about, right, yesterday. When GAAP is concerned, GAAP is very, very categorical in its, GAAS is very, very categorical in its mentioning that when I'm talking about auditor's responsibility, typically my responsibility will end on the report release date. I will not have to think beyond the original report date. Because see, if you look at it practically, only at the fag end of the day when we are actually closing everything is the audit report dated. And ideally, there is no delta between the original report date and the report release date. It's just that in the evening, you sign the audit report, and in the next day, following morning, the audit date, report is released. But let's say because of some unforeseen situations, there was a delay between the original report date and the report release date. Now, typically, if that happens, it will not be more than 1 or 2 days, because no auditor would want to extend or get into that position where 1 or 2 days only will make a difference. So, first of all, understand that this area here is a very, very remote possibility area. This does not really happen in the real world. So what we say, see, the day when you, because this is the date which actually gets circulated to the public, because this is the day which is mentioned on the audit report. We say, see, as an auditor, you are supposed to look for all the subsequent events till the date which is officially circulated to the shareholders. Once this date is frozen, actively, you are not responsible. So we say, okay, then what are we supposed to do during this time? We say, okay, you do a lot of stuff. You go and, so how would you ensure when the management has given you all the requisite disclosures? How would you do that? Okay, so we say, okay, what you can possibly do is this. See, what you can possibly do is this. You can go through a lot of meetings. Okay, so what happens now? My job is to ensure completeness. How do I ensure completeness? That between 31st December and 15th Feb in my example, if there is any untoward incident which may affect my current or future shareholders, I need to intimate them to the shareholders. Now, see, conditions existing as at the balance sheet date, generally, there would not be a a lot of confusion in finding that out, because there is a precedence, right? You have certain situations and you get a letter from the legal department and all of that is happening, right? So typically, recognize subsequent event is not a very big deal. The problem comes of unrecognized subsequent. How do you ensure that the unrecognized subsequent event has been properly disclosed? So, what do? You will assume that the client has not given you the full data. Then, where do you start? Okay, you will start with studying all the post balance sheet transactions. What has happened after 31st December and before 15th Feb? So, give a scrutiny of that. So, generally, what we do is we take a trial balance and just take a overall scrutiny to see whether prima facie is everything remaining okay or not. Then what you do, you get a, this is very, very important, get a rep letter, because tomorrow if something goes wrong, we need to fix the responsibility to the management also. Now see, one thing I want you to understand, that before the Sarbanes-Oxley Act, we did not have so many rep letters given by the management. What I meant was, what I mean is the management representation letter. We didn't have that. So what used to happen is, at the time when there was an issue, management used to go scot-free. We did everything. It was the auditors who did wrong. So what we did, post the Sarbanes-Oxley Act, when we overhauled the entire auditing process in the US, what they did was they froze a lot of responsibility on the management. They said that you have to specifically write. And when I say write, it is the CFO and the CEO. They will have to pen down and write that, yes, I have set up a system of internal control. Yes, I have communicated all the deficiencies noted in my internal audit to the external auditors. I have made them available all the information. I have made a fraud inquiry and I am giving you details about fraud. And I give you that in writing, signed by CFO and CEO. The moment they made that, automatically every company started having a internal, they wanted to have an internal control department. And then we introduced the COSO framework in great details. We made a lot of changes there and we said that, see, this is how I want your internal controls to be. So remember, in every audit responsibility, wherever you have to ensure completeness of certain information which is beyond you, you need to get the representation letter from the manager. Conduct inquiries. Typically, we talk to the legal counsel of the client, of course, with the client's permission. You read. This is very important. You read a lot of these minutes of the shareholders, directors, the committees, right? The remuneration committee, the audit committee, all of that. We read the minutes, and most importantly, you read the latest financial statements. So, see, many a time, especially in India, let's say 31st March is my year ending. Typically, it is May, June. By June end, we come up with the annual audit report. Now that is the time when my interims are also going to be out, right? April, May, June, my interims are going to be out. So they say that whenever there is an imminent financial statement, you need to compare your financials with that and see whether prima facie everything looks correct or not. So you cannot say that management is not reported subsequent event to me. It is no job of mine. You cannot say that. You will have to come up. So see, currently there is a lot, if a company has a lot of exposure in Israel, it's very important that you factor that in and give a subsequent event for that. So there are certain things that the auditor would be aware of. There are certain things which are business specific, auditor might not know. So what you need to do, so remember, there is an active responsibility of the auditor to look for subsequent events before the original audit report date. There is an active auditor responsibility. So what are recognized subsequent events? These are events that exist on or before the balance sheet date. You evaluate them looking back. And what do? You restate your financial statements. Non-recognized subsequent events are events that occur after the balance sheet date. So you look forward from the balance sheet date and then find out if there are any such events that has taken place. Please remember, no adjustments. So no journal entries are required, but you would require footnote disclosures. Many times, let's say if there's something which is so, which is so stark that has happened in your company, and your company might just close down. You will give a supplemental disclosure and you might give a pro forma financial statement. Let's see if this has happened. And if this would have happened by 31st December, this would have been the situation of your financial statement. So that's called a pro forma, something which is not exactly right now, but what would have been if this is the situation. So in extreme situations, even that can be given. Okay, and it is an auditor's active responsibility to look for non-recognized subsequent. If this is a gray area, and that's the reason, don't forget management rep letter. Management rep letter is a very, very important factor. Okay, what happens again? I'm talking about a very rare situation here, if you understand, because most auditors are not comfortable with this hiatus. But if there is a delay, which is not more than 1 to 2 days at the max, what do you do? The first thing is, I am not actively responsible. There is no active responsibility of the auditor. However, if something comes to your notice, something suddenly comes, the factory has got fire. I have only one factory. I'm in a roaring business of, let's say, lithium batteries, which has become a huge success from India. Suddenly, my only production facility caught fire. Now, that's a humongous information, and you cannot release a report with that information missing. So, what you should be doing, uh, please understand that in case if the report has still not been released, but there's something which has come to your notice, which is extremely material, you need to decide whether you want to restate your financial statement. So understand what is that particular thing related to. Is it a recognized or a non-recognized subsequent event? If it is recognized, go and restate your balance sheet and give a footnote disclosure. If it is non-recognized, just give a footnote disclosure. But what if the management refuses? He says that, see, we are already finalized our audit report and our financial statements. We shouldn't be going back. If the management takes that stand, you still have your audit report, which has not been released. You can still qualify your audit report. Okay, you can express unqualified or inadvertent. Why? Because if a subsequent event which is recognized and non-recognized is not disclosed appropriately in the books, as an auditor, you are still liable to change your audit report and ensure that the correct report is released by the report release date. However, if management agrees, and this is important, guys, there's this concept of dual dating. What is dual dating? Dual dating means, now see, generally, whatever date you mention on the audit report date, you have active responsibility for subsequent events till that date. So, what people do is generally, whenever they have to change a very minor thing in the audit report or in the financial statements, they would not want to change the date of the audit report. Why? Because then all their responsibilities extend to that date. So generally what auditors and the management does is this. They say that, see, for everything else, my date is the original report date. Only for this event, I dual date. Only for this event, I extend my responsibility to a new date. But remember, the date of the audit report is a very important date because all the events till that day are actively auditor's responsibility. Okay, so remember, till report release date, I am still actively responsible for letting the users know if there's any major development. Even though between this date, I'm not responsible for looking and hunting for the subsequent events. That thing will stop at the original report date. Now, once the report is released, typically auditor has no active responsibility. But if there's something which is really big, which comes to the notice of auditor, then he says, oh God, we made a mistake. We should have gone back and restated. So if there is a subsequently discovered fact, oh, I completely forgot to check the legal counsel's notice. Oh, I completely forgot to check the board of directors meeting. They told me, but I did not go through it. And now I realize there's something very big coming out of it. So something which would have made your original report of the financial statements to change had this knowledge been available to you then. If that happens, what do? Please advise the client to issue the financial statements along with the new audit report. So what you want them to know is, now see, this is a huge embarrassment for any auditor because you're publicly accepting that you made a fault, okay, which is going to tarnish your reputation. And typically, if any auditor does resort to it, it would be in the extreme situation of saving his own skin. We have boiled down to something which was like a Satyam fiasco, and now this is our last attempt to save a skin. So generally, if something like this happens, the engagement partner is in a big soup, but the firm will be saved. So what do? You tell the client, please let the shareholders and everybody else know that these financials are revised and restated, and I'm going to change my audit report as well. Advise the necessary disclosures or revisions to any imminent financial statement. So imagine 31st March, your accounts are closing. 15th April, May, let's say you are trying to release your report. And suddenly by the time end of June, you realize that, see, there is an error. So what we do now, 31st April, May, June, the quarterly or the interim review of June is also now pending. So what you do, you please make revision in the imminent financial statements. Okay. Or if effect on the financial statements cannot be determined, you really don't know, it was such a big bomb, your license has been scrapped, something which is really big for your company, then you provide notification that the financial statements and the audit report cannot be relied upon. In the worst case scenario, when you cannot pinpoint and say a figure that's really huge for you, you come ahead and you let the clients and the users know through the client, please do not rely on this report. This report is not actively reliable. If the client refuses, client says, I'm not into it, I am ready to take the ball a little further. If we are caught, we are caught, but I don't want to leave it here, because if I do that, I'm informing everybody from my end. And the auditor does not want to get embroiled in this. What do we do? So go a level above the management. So go and inform each member of the board of directors of the fact that the auditor will take additional steps. Now, see, general rule, there is a confidential relationship between the auditor and the client, which we cannot breach. So you will see when you're doing ethics, even now as a CPA, that is one area that they want us to actively, every year we're supposed to read the ethics and we're supposed to take the exam and then we're supposed to go ahead. Why? Because ethics is very important. And one of the things there is confidentiality. So this is an area where I'm going to breach the confidentiality. I'm going to go and talk against my client to outside agencies. So I'm going to tell them that, see, I told you to change this. I told you to let the users know that the report is no longer reliable. You did not agree with me. Hence, I'm going to give a public notice, typically in newspapers, saying that for this particular client, I am not associated with the financial statements anymore. I'm going to alert all the agencies, which is SEC, any other regulatory government, everybody. I'm going to give written notices that this is the problem. I'm not associated with them. And also to the shareholders, an open notice will be served saying that we were the auditors, there was an issue, the client did not agree. Hence, we are not ready to be associated with these financial statements, and these statements should not be relied upon. But understand that this is the extreme scenario. It is not the scenario which most people would generally think of. But if this happens, this typically would take place in a scenario when the auditor's entire credibility is at stake and they don't want to do it. Is this clear? So see, what is very important in questions that come from subsequent event is that you understand at which phase you are in. Is it between the balance sheet and the original report date? Is it between the original report date and the report release date? Is it a subsequently discovered fact? And then what is the scenario of the subsequently discovered fact? So if you look at it in terms of a step-by-step process, understand the call of the question. You will know the answers to this question really well. Understand the call of the question. That is the only area where they can trick you in this. Okay. Uh, do you clear? Hmm. One second. Okay, there's a question. Let me just complete this. Okay, so first thing what you do is understand, is the client following GAAP? If it is, one. If it is not, now till the report date, the original report date, what are you doing? Actively responsible to look for subsequent events. And then you go to step 3. After the report release date, not actively responsible. However, report appropriately if something comes to notice. Is this clear, guys? Everybody, is this clear? And the last step, which is step 4. Step 4 is very easy. Step 4 is look for, respond appropriately in case of, subsequently discovered facts. In case of subsequently discovered facts. Once again. Is this clear? Step 1 is the client following gap. If yes, great. If no, rephrase your audit report appropriately. Then, till your original report date, you have an actively responsibility. So, what do? You do a lot of stuff. Get a management rep letter, that's very important. Scrutinize your financials, your imminent financial statements. Third, read the minutes of the meetings and stuff. Talk about all the communication that you receive from external parties like the taxation authorities and the legal counsel. You have to go looking for active subsequent events. Once you release the report, stop. But if something comes, respond appropriately. And once everything is done, the report is released, then you realize there's something that went wrong, then also you have to report appropriately. Okay? Everybody okay with it? We'll take a question here. We got a good sim here. Let's take that sim. I think this will really give you a very wholesome picture of the entire thing. And once this is done, then I'll first take a query that Lakshmi has put, and then we go to the last topic in this area. Okay, please write your answers in the chat panel. Carlson LLP is auditing the year 1 financial records of Peterson LLC, which is a publicly traded manufacturing company. Stop. The moment I say publicly traded, it's an important information for me. Why? Because I know it's an issuer. Peterson has a 31st December year end. Carlson performed their year-end audit during January and February of the second year. The financial statements were issued on the third month, 15th March of year 2. The date of the audit report. So they have already told me that 31st December year 1 was the account closing date and 15th March year 2 was the audit report. They have already told that to me. So, okay, each one of them, I'm going to take it and I want you guys to answer. I'll take turns in case if you guys are interested. Review of post batch. So, what is it that when I'm doing the subsequent event audit procedures, what is it that I should be doing? Right? So, as an auditor, what are the stuff which will entail my subsequent event auditing process? What should I be doing? Okay, the first one, review of post balance transaction. Shall I do it? Yes, no. Answer in the chat panel, guys. When I'm reviewing my post balance sheet transaction, shall I review it? Yes. Shall I not review it? Yeah. In most situations, I'm supposed to scrutinize the post balance sheet transactions. Guys, please write one and then write the answer. Otherwise, I will not know for which you're replying. So yes, most of you are correct. We have to scrutinize the post-balance transactions. Do you look a search for unrecorded liabilities? Do I go and actively look for what are those liabilities that has not been recorded? 2. Do I go hunting for unrecorded liabilities? So Lakshmi,